right, everyone. Thank you for joining us tonight here at the Wealth Mission Group webinar. We are so excited to have you all here. Just want to get started with a quick disclaimer. We wanted you to know that this is a offer that we would like you to do some due diligence, and this is an offer that you do need to take into account, and this isn't a guarantee. So with every opportunity, please do your own set of due diligence. We are the Wealth Mission Group, myself, Maria Marks, with Michael Guthrie, Samantha Gundry, Dwayne Winkle, and Ashley Winkle. Together, we have a large portfolio, which is why we feel like we can be here to talk to you today. So our portfolio comprises of 93 million raised capital, 2.3 billion assets under management, 13,000 and a little bit over 13,000 doors under management in our portfolio. Oh, I'm going too fast. Got too excited. We've got 48 properties in our portfolio and 60% repeat investors. That number is actually what I'm mostly excited about. The repeat investors is something that's personal to me, so I'm very excited about that. We do partner with Cash Flow Portal, Provision, and our legal advisor, which is Smith Law. And we do want to showcase who we are partnered with because it's really important who we are working with. We want to bring you guys the best, and that's who we are working with. So today we are talking about your investment portfolio's missing piece. It's something that we wanted to talk about because all of us are investing, and we want to talk about what it is that we bring and why it is so important to have that lasting missing piece. So with real estate, there's so many different avenues that you could be investing in. And most of you know this, but I just wanted to let you know, just in case you didn't. We've got some residential real estate, mostly single family. There's some commercial properties like office, industrial. Then there's some REITs, which are the low barriers, less control, maybe more liquid. You might see those in the stock portfolio. Some short-term rentals, development, and multifamily. Multifamily is usually what you see when you see real estate portfolios, but it could be any of these vehicles when we talk about real estate. But when you think about investing, there's a liquidity time that's super important here. The liquidity time is how long before you get your, which if you think about the stocks, that's an immediate return sometimes. With bonds, it can take anywhere from 1 to 10 years. With residential and commercial real estate, does take some time based on when the properties do sell. REIT could be immediate because it is part of the stock market, and development could be like the commercial real estate, depending on when the properties sell. So that's why it's so important to diversify your assets, because the time to sell and the time to get your investment back is so important. So why real estate? I get this question a lot. It's something that everyone asks, especially when I first got started in investing. Real estate was not at the forefront of my knowledge. Didn't even know about it, actually. When I first got started in investing, I thought the stock market was the only thing that you could invest in. But I was actually misinformed. And being a nurse by trade, the real estate market is very exciting to me. It's tangible. It's something I can see. It's something I can drive up to my properties. I can go see it. I can touch it. I can talk to the residents. I can go do all of those things. It's why I love real estate so much. Stock market, I know it makes sense to a lot of people, does not make sense to me. I cannot drive to the stock market. I wish I could. I can't do that. So it doesn't make sense to me. It's not a tangible asset, and it doesn't help with inflation. But real estate is so amazing because of that cash flow ability. Whether it's monthly, quarterly, or you're waiting for those cash flow investments, cash flow is amazing. It's why we're all in this. We're not in it just to say we have assets. We're really in for the cash flow influx to our bank account. Appreciation is that long-term growth that we were all showcasing on those multifamily units, the ones that are selling in 5 to 7, sometimes 10 years. That's not appreciation growth. The tax benefits is the other side, the depreciation. And the tax benefits is so important when it comes to real estate investing. And then that leverage side. The leverage is when you're using other people's money to grow your wealth instead of your own money to grow your own wealth. But when it comes to diversification, that's also why we get excited with real estate, because there's so many ways that you can invest in real estate, from single family to fix and flips to a triple net or to traditional multifamily investing. But when you think about the puzzle of your investment portfolio, you want to have one of everything. You want to have some things that are going to appreciate over 10 years. You want to have something that's going to have some tax benefits, but you also want to have something that has that consistent cash flow. And if you're looking at your portfolio right now and you don't see that consistent cash flow, that's where we come in. And that's why we created this fund, because we are that missing piece. We're that piece that you need to add in to your portfolio because we can deliver that consistent cash flow. So I'm going to pass it over to Mr. Michael Guthrie.
Hey, I just want to thank everybody for showing up tonight. We're going to probably be in about another 15 to 20 minutes of conversation around what we're doing and why we're doing it and why it makes a big difference. And just like you, Samantha and I and everybody on this panel has invested in some amazing multifamily real estate assets, probably even some trailer parks, some self-storage, and some triple net leases. And as we know, with most of those assets, the monthly distributions have really either shrunk or dried up. We're not saying we don't like those asset classes. We're not saying we're not still investing in them or still even partnering with people in doing those assets. But what we're saying is I can't eat the net worth that's been created with these other assets outside of my current portfolio. So what me and Samantha did is we did a pivot because we had sold our company. So we had a liquidity event, put a lot of it into multifamily, into some gas station leases and some triple nets and a ton of apartments. We figured since that money was starting to dry up, we didn't want to eat our principal that we had saved in the bank. So we turned to private credit. Private credit is also known as hard money lending. The definition directly is it is a non-bank lending directly to borrowers. And that's what we're doing with our fund. And why does it matter? Because these borrowers are underserved. We can get higher returns in a stable asset class. You can contrast that to what Maria was talking about earlier with traditional fixed income bonds or treasuries, which typically pay 2, 3, 4%. I think the 5-year treasury right now is at 3.9. It ended today. So if you could buy it at 3.9, that's what it's going to pay. It's going to pay you a 4% return. Our lowest investment pays an 8% return. And it's consistent because we're lending the money. We're not waiting for somebody to go out and sell an asset, improve the value, increase the rents for us to be able to pay. So why do investors choose private credit? It's predictable, consistent monthly income. Lower volatility versus stocks and crypto. I know there's people that like to play in those speculative assets. I have a ton of friends that do also, but I like to eat. And I can't eat when the crypto goes from, I had a friend buy 60,000, it dropped down to 15,000 within 6 months. It's hard to eat that kind of depreciation, but now he's really happy because he didn't sell. He waited it out like we all are in the multifamily realm. We're waiting it out today because we're just taking our time, but we had to find a way to create cash flow so we could continue to eat. All of our private credit's always backed by hard assets, i.e. single family homes, duplexes, triplexes, 6, 8, 10 door small multifamily. And the risk adjusted returns are far superior to any traditional investment because we are loaning on an asset. Our targeted returns are 8, 9, or 10% paid monthly. You might want to, let me go, we'll talk about the assets here since we flip slides. We do a lot of fix and flip lending, private credit on single family homes, small commercial or multifamily. And we have strategic investments with other partners where you can actually, we JV. So we go in on any of these opportunities. We don't go any more than 75% loan to cost. So that gives us a 25% buffer upside, which makes this investment a lot more conservative. If we have to take the investment back, we have no problems getting all of our money back out of it. So just making sure I'm not missing anything. How does this work for you, our investors? Is there's a simple onboarding process where we can make sure you're accredited. Your funds get deployed into the pool. As the pool gets some cash in it, we deploy that cash out into an asset. First cash in, first cash out. And once it's deployed within 30 to 60 days of the deposit coming into us, we'll let you know when your money's been deployed. That's when you'll start earning your return. And if you put your money in today and it goes out on the 15th of this month, you'll make 15 days worth of interest that'll be paid out by the 10th of June. And then the 10th of July, you'll get paid the full percentage of what you've actually earned because of your money that have been working for a year. We do ask that with all of our investments into our fund that you lock it up with us for 12 months. And then after 12 months, you have an option to withdraw that money at any point in time with a 60-day notice. We don't have to sell assets because there's money coming into the fund all the time that we could get you your money back out. But when we do our loans with these assets, we do a 12-month loan with the borrower. So they know they have to be in and out of that asset in a specific amount of time. Otherwise, there's penalties to them to continue moving down the road. How did we get the competitive advantage? We were working with a guy that's been doing this for over 20 years. He's deep into the Arizona marketplace. He's very conservative and principal protecting philosophy of making sure that the investors are not overexposed into any asset class. Arizona is the 5th largest city in America, and it's growing rapidly. There's so much expansion going on here. And Arizona's laws are pro-business and strong job growth is what's really propelled us into doing this. And that's why me and our team here, we're only deploying capital in the state of Arizona. And there's a huge demand for housing and taking old houses and making them new again because the builders can't build the product fast enough. So we're working with a stable economy, and so our risk is fairly low. Next slide. So here's our predictable cash flow. I wish I'd produced a different slide. I'm going to have one for our next webinar that shows if you put in $100,000 at 8% for the first 15 days of the month, say you put it in, you only get 15 days, and then it'll show you how it will grow over time and how you'll get paid every single month. This isn't a check showing up in your mailbox. This is an ACH showing up in your bank account every single month. So that's the beauty of loaning the money as opposed to waiting for renters to pay. The borrower always pays because he doesn't want us coming to take the property back. Next slide. So how it works, we say you can invest once and then we allocate across multiple properties, but you can invest once and then again and again. And we'll get back to that. We'll come back to that slide in a few seconds, but we allocate across multiple properties. You start to receive your monthly ACHs within 60 to 90 days. So if you put it on the 15th now, you paid out on the 10th of next month, and so on and so forth. We'll provide monthly updates on how much money's in the fund, how the fund's doing, what our loan to value is across all of our assets. And you can pull your investment out or continue investing after the 1-year time period expires. It's your choice. We don't want to lock you up for 3 to 5, 7, 10 years. And I know it's going 5 to 7, maybe even 10 years on some of my multifamily assets, because the only thing that fixes those bigger assets is time. And as long as we have the time and the wherewithal to withstand the growth of the markets, that's where we're going to go. Next slide. This is for accredited investors only who are looking for passive interest income without having to do due diligence or any management responsibilities. I know for me in the multifamily space, I was only supposed to help raise some money and then sit on the sideline. And I find myself weekly on 8 to 10, sometimes 12 calls, watching over property managers and our asset manager to make sure we're doing what we say we're going to do. Because as me as an investor and me bringing in investors, it's my job to help preserve their wealth without them having to sacrifice bringing in more money to the deal or sacrificing their lifestyle. And you have to be willing to release your initial investment for at least 1 year when you put it into the fund. That's who this investment is for. Now I'm going to open it up for questions. If you want to raise your hand or drop your questions into the chat, you can ask us anything. So if you were to put $100,000 into the investment, how much would you get as a return? So it's very simple. You go 100,000 times 0.08. You'd return $8,000 over a 12-month time period. You divide that by 12, you would receive a wire into your, or an ACH into your bank account on a monthly basis once your 100,000 has been deployed for a month, of about $666.66. I'm not sure I like that number. We may round up to 667 just because I'm not
There we go.
Our minimum investment into the fund is $50,000. Me personally, I've been investing in private credit for almost 24 months now. I have deployed a little right at $2 million into this of mine and Samantha's personal money. And I wanted to do it first so I could prove out the model and prove the stability before bringing it to everybody else. The money where are we putting money that has not been loaned out? It is sitting in the fund until the next deal comes. That's why we have 30 to 60 days to get your money deployed, because we're vetting deals all the time, but we're only putting our money into the deals that make the most sense for us and give us the best returns for you, the investor, and keep our risk down.
So we're really acting like a bank. And that's what we really wanted to explain that more to you guys. It's a really good addition to what you currently have in your portfolio. And like said, I myself have 12 multifamily properties in my portfolio right now, and I'm not getting consistent cash flow. And that's why this is so exciting to me, because while I'm waiting for that money to appreciate over time and waiting for those properties to sell when it's the right time for those properties based on the pro forma, I would like some cash flow. I would like those numbers to be coming back to me. So this is a nice addition to what I currently have in my investment portfolio right now. So it is nice to have that as an addition. It doesn't replace what I have. I'm not saying I don't love multifamily. I do love real estate and all those other revenues to invest in. It's not replacing it. It's just a different addition. And what I can do with that monthly cash flow, very exciting to me. And I'd love to hear what you guys are going to be doing with that. And that's probably what we'll be talking about on most of our calls when I do talk to you on the phone.
So there's a question, when do we need the money by, and is there a time frame or deadline? We are going to continually be raising because we're continually getting deals. We're currently sitting on about $250,000 worth of deals that need funding within the next 12 to 14 days. So we could actually use a little bit of cash coming in immediately. So your cash gets in, it'll get back out working. So there's not a delay. As we grow the fund larger and larger, then there could be some delays, but right now we have an immediate need for some cash. I'm going to see if I can go to this other. Oh, there we go. I got the other Q&A up. How often do you show the investors how the money is being invested? That will be shown every single month with our monthly reporting, Ron. That is a great question. And I know that in other asset classes, the asset managers and property managers aren't always reporting on a monthly basis, but we are going to report on a monthly basis how much money is in our kitty, how much money's been deployed, and the assets it's been deployed at, and what the loan to value on those properties are. Great question. Demetria's question, and it's a beautiful question. I did not cover that. What is the typical position you are in as the lender? So you do not run into issues if the bank involved is in first position. How is that handled? On these properties, our note is typically in first position. There is no bank. Mic drop right there. That's why when we loan 75% loan to value, we are loaning the first position on that capital. That way we own the home until that borrower actually pays us off. We are actually on title. So that was a beautiful question and very well timed. I completely missed that in my notes to share that with you. And as I do more and more of these webinars on this, I have all this stuff in my head and I want to make sure I get it out to you, the investor, so then you understand exactly what we're doing. I took a 40-minute call yesterday with somebody that watched one of the webinars. And after I was done explaining, he was like, I completely get it now. And I'm trying to make sure I'm getting all this information out to you in a short period of time where there's an understanding. But basically what we're doing is we are the bank for fix and flippers, because a fix and flipper to go to a traditional bank will take them 35 to 60 days to close. And when they're buying a home or committing on a home that's on the court steps, they have to have the money available to fund within 24 to 48 hours to the courts. So they can't go find a traditional lender. That's why people borrow money the way they do in this space. And if they're only going to borrow it for a year, their time cost of money is a lot smaller than what it would take to actually try and get a traditional loan from a bank. The borrowers that go ahead. Do you want to answer?
Cool. I'm going to read it for you. You're good.
Thank you, Seth. What type of due diligence are we doing on the borrowers? The borrowers that we're working with have done multiple deals with us already. And if we're going to work with them for a first time, they typically will pay a little bit more money to borrow the money, and they'll get a lower loan to value. The highest loan to value we are doing is 75%. Somebody that hasn't borrowed from us before, that their credit doesn't check out, they're actually going to pay a little bit more for the loan, and they're going to get less funding from us. That's just the way this market works, because we want to make sure that we are doing everything we can to protect our investors' money and my money that's already out there and in this fund and on the streets working. So that's how we do it. We check the property. We run our own, not just a Zillow, but what do they call that? An appraisal on the property to make sure that we're not loaning more than what the property is actually worth. That's why we go in at 75%, no more than 75% loan to cost, not loan to what they say the value is, or what Zillow or Trulia or Redfin or any of these other companies say the value is. It's what they're based on what they're paying for the property. Great question.
Chris is asking, are the investor funds fractionalized over different projects? How does that work when we have multiple projects?
There's going to be multiple projects across the fund, and say if the project was a $400,000 loan, and I had 8 $50,000 investors, those 8 $50,000 investors are invested in that one project. And then we allocate the funds to the next project from what comes into the very next project that's available. I hope that answers the question, because that's why we're raising a fund right now. With our money, I can do an $800,000 project because I have enough money that I can go personally do that. But if we're doing this as a group and as a fund, as funds come in, first funds in, first funds out. And that's this how we're doing it. And it's allocated based on the need of the project. The other thing the borrower has to provide is insurance with us as an additional insured on the property, and a personal guarantee. Those are additional ways that we're actually ensuring that we get our property and our money back out of that property when the gentleman goes to sell. We're actually on title. They have to pay us off. That was a great question, Chris and Demetria. Thank you very much for your question. Who are we partnering with that has 20-year experience in this field? The gentleman's name is Jules, and we are actually going to have him on in a webinar, probably in about 4 webinars down the road, once we get more money out with him from the fund, so then he can come in and talk from the experience of working with us. Also, I've been working with him directly, and he had come to me as I was putting more money into his fund and said, "You're really good at the money side. Can you raise money for what we're doing?" Because he's more of the technical fix and flipper kind of guy, and he really understands the real estate side. Not that I don't, but he understands the real estate side and the mindset of the fix and flipper, because he was doing that also as he was loaning his own money out. And he's been doing this over 20 years between Phoenix, Sedona, and Tucson. Chris asks, is the investor entity / IRA actually listed on the loan docs? Just curious of the documentation involved for the fund. If you want to put in, Chris, via your self-directed IRA or solo 401k or via an entity, your entity will be contracted with our fund via our PPM directly, and our fund is the owner of the asset when we go out to loan the money. I hope that makes sense. So your entity will partner with Wealth Mission Group, and Wealth Mission Group will partner with Lend Money, Make Money, and Jules. Seth, are you planning to take on any debt for the fund, and are you servicing the loans yourself? Jules is servicing the loan at the loan level, and Jules is paying us directly from the borrower. So we're not actually servicing the loan, Jules is. And we are not at this point in time planning on taking on any debt in this fund. We are planning on funding the deals from the fund 100%. Will a recording be sent out? Absolutely, Demetria. There'll be an email that goes out tomorrow You'll just click a link in the email that says you want the recording that we had recorded here tonight, and you will get a copy sent directly to you. Another great question. Stay on as long as you have questions, and I'll give you guys about another 5 or 7 minutes of questions, and I'll sit here and just wait. Because I want to make sure everybody has everything they need to know. I get so much stored up in between the 6 inches of real estate, and it's not always my friend, because it's like a steel trap. It gets in, but it doesn't always get out. And I just want to make sure that as I explain and Maria explains this to you, that there's an understanding that you have so that you have a comfortability of working with us. And if anybody wants to have a one-on-one call with myself or Maria, you can go to wealthmissiongroup.com or scan the QR code. That'll take you to a link in Cashflow Portal where you can book a call with us to have a one-on-one call. I believe Chris, I believe that it's not going to be a K1. I believe it's going to be a 1099 as interest income. I will check with Provision to verify to make sure how that's going to show up on your end of the year reporting so that you'll be aware of how that works. There we go. There's a link in the webinar chat to book a call with Maria. And I think if you put, instead of putting Maria at the dash at end, you could put, I think it's Mike or Michael. And you could talk to me too, but everybody likes to talk to a pretty lady.
Thank you. I'll take it.
There we go.
Well, while you're putting in your other questions, next webinar will be May 20th. We'll be talking about lending funds and how it works. We'd love to see you there so you can bring more questions. Love for you to sign up. That's also in the email that you'll be getting if you want the recording. So just remember to check your emails tomorrow and sign up there. We'd love to see you, or we don't want you to miss out on an opportunity to learn more about funds and why we are so excited to be talking about them. And if there are no more questions,
it is 5:33 and we want to respect your time, and we thank you all for coming out on this beautiful Tuesday evening. We will be back in 2 weeks with another update and let you know where we're at and how much more money we need. We appreciate you showing up tonight. Thank you all.